What is up, everybody? Welcome to the GrowingAU show, where we are going over the stock market's winners and why is losers really, really big? Oh, that's right. Today, folks, we are talking about the possible stock market crash of 2020. Is it going to happen? Why is everybody freaking out? What should you do as an individual investor? This is going to be one heck of a video. Let's just roll that intro and jump on into it. This is the GrowingAU show. First thing I want to say very clearly at the beginning of this episode, you cannot time the market, so don't try. All right, people have tried to time the market before, and some have lost, some have succeeded, many have failed. You can't time the market, okay? The only reason we're even talking about the possibility of another stock market crash in 2020 is because, for whatever reason, it's been growing in popularity recently. A lot of people are talking about this, a lot of websites are reporting on it, and we're going to be talking about and breaking down some of the facts that these websites are worried about regarding everything that's happening with the stock market. Today, we're going to be referencing two articles specifically, one from Market Business Insider and one from Forbes. Those will be both listed and linked below, so you can go ahead and check them out, along with any other information we use for this video. Okay, so it's no question that the stock market has been on a roller coaster ride over the last couple weeks. Since the outbreak of this pandemic, it seems like total market rises and falls of 5% per day have been commonplace in recent history. Now, thankfully, we've risen quite a bit from our lows around 19 and 18 in the Dow Jones up to about 24, 25. However, there are people saying that the darkest days are still to come, and we could have an even greater depression coming up. One of the big indicators of this is Warren Buffett's stock market indicator has recently reached an all-time high and has spiked. This sudden surge in the indicator could be signaling that stocks are overvalued and overpriced. So what is this Buffett indicator and how does it work anyway? The indicator takes a country's combined market capitalization from all of its stocks and assets and divides it quarterly by the GDP. Investors use this indicator to judge whether the stock market is under or overvalued compared to the economy. Buffett himself is actually quoted as saying it's probably the best single measure of market valuations at any given moment. Now, several flaws are actually necessary to point out in this indicator and actually its effect on the stock market. It doesn't take into account a country's profits made overseas. The other thing is we have to make it very clear, the stock market is not the economy. Even though it may seem that the two kind of go hand in hand or complete opposites sometimes, the stock market is different than the economy. There are times that the stock market will go up despite a bad economy, and there are times that the stock market will drop despite a good economy. So it's very necessary to show that it is a marker on the economy. And before we jump back into what's going on with Warren Buffett's indicator, it actually makes sense to talk about one of the reasons that a lot of people are claiming that the stock market is going to crash again is because of economic factors. Unemployment is ridiculously high right now, and many people are claiming that once people come to the realization of how bad things are, that things are going to go ahead and collapse, and that right now we have an overpriced bubble growing in the stock market. But we have to remember, though, that, like we said, stock market is not the same as the economy, and both can do drastically different things. Despite all those flaws, however, this indicator has been right before. It jumped 118% before the 2000 dot-com crash, and it topped 100% just before the 2008-2009 financial crisis. It's done well at predicting financial crises in the past, but like we said, you can't time the market, and you can't simply judge the market based on past things that have happened. The future is always going to be different. We can't forecast the market. I'm going to keep saying that throughout this video because it's so important. But despite the fact that we can't forecast the market, people are still claiming it's going to crash. So if it does crash, if the market decides that I am done, I am out of here, peace out, we're going back down, what does that mean? What are some of the ways that could cause that? And what does it mean for us as investors? This Forbes article is really worried about the economy because of the fact that the Federal Reserve and other central banks and their governments are levitating stocks with galaxies of new money. Meanwhile, their economies are atrophying. So the Federal Reserve is pumping and printing new money while the economy is simply just not doing well at all. So they think there's a couple different things here that can happen. The first one is a deflationary recession. Essentially what's going to happen here is demand's going to collapse. That will cause industry and infrastructure to enter a dramatic period of contraction. Everything's just going to start to fall back in on itself. This leads to people not spending any money whatsoever. So that's often people saying, oh, the stock market's going to go back up because as soon as all these bans are lifted, people are going to go out and spend a lot of money. This is claiming that that's not going to happen. All people are going to do is start hoarding their money and stowing it away at 0% interest, and that's how it's going to sit for a very long time, causing, as we said, the industry to just contract on itself and affect stock prices. The next thing that could possibly happen is simply back to normal. This is saying that people are going to get out there and start spending the money. And they claim, actually, I like this here, they say that miserable investors have a tendency to make mountains out of molehills, that maybe it's not as bad as it seems, that once people get out there and start spending money, we're going to get back to a relatively normal state. And if that happens, great. That's a good thing. We want to get back to a normal state. We want things to keep growing. The other thing that Forbes said could possibly happen is high hyperinflation. Now, hyperinflation, as described by Wikipedia, is a very high and typically accelerating inflation. It quickly erodes the real value of the local currency as the prices of all goods increase at the same time. This causes people to minimize their holdings in that currency, and they often say, normally then going to invest in the US dollar. Forbes talks about hyperinflation. Essentially, it'll switch out acute problems from the chronic ones, saying that the Fed will just keep pumping more money until we get out of the situation. And then finally, from the last article that we want to address today, from the marketrealist.com, they give us a couple numbers to take a look at here. So U.S. stock markets had a splendid April. Dow Jones gained 11.1% in April, while the S&P 500 gained 12.7%. What they're talking about when it comes to a possible another collapse is actually the thing that I've heard the most about, which is a double bottom. So essentially, we bottomed out in around, early March. We raised back up to where we are now, and then we're going to bottom again, and we will raise up out of that. It kind of looks like a W, so a double bottom. If you could think about that, it starts up, down, up, right? So it's a double bottom, and I realize that W is backwards for the rest of you. But anyway, a double bottom is what they're talking about. I've heard a lot of economists and just people talking about the possibility of a double bottom. Deflationary recession would push us into that double bottom because the spending would stop and the industry would collapse. What I think we need to take away from all of this, if you're driving a car, okay, and your check engine light comes on, it doesn't mean that your car is going to break down in the next mile. Just because that light comes on, or just because you have low gas pops up, it doesn't mean that you can't make it to the next gas station. It doesn't mean that you can't drive for a little bit longer before getting the car checked. It doesn't necessarily mean impending doom. It just means that stuff could possibly be going wrong. It's not a perfect analogy, but that's kind of the way I like to look at Warren Buffett's stock market indicator. It's a check engine light for the stock market and the economy, which, as we said before, aren't directly related. But as we know, the stock market is anything but rational. The stock market is completely irrational. So even if the best indicators in the world were saying the market's going to crash, it could just rally the next day, and we would be worse for wear if we all decide to sell all of our stock. So the point of that is you can't time the market. The best investing strategy, buy in and hold for a very long time. It's going to give you the best possible numbers over an extended period of time, but just buying and holding is one of the best and most profitable investment strategies. The way that Forbes talks about it right now is having your portfolio broken up by 33, 33, 33. So 33% stocks, 33% commodities and Bitcoin, 33% cash. I know nothing about the Bitcoin market. I know a little bit about commodities, not enough to comment on here, but that's the way that you could break it up to have 33% of everything, but still have money in the stock market, still have money in your commodities market. One of the things I would recommend is actually looking into the capital asset pricing model, CAPM as they call it. What that talks about in that model is that technically you want to own a little bit of everything. Now, I should say that model is not perfect. It does assume that everybody is a rational investor and that everybody wants to do the same thing and that everybody has an optimized portfolio. But what it does say is that the more types of assets you loan, the more potential gains you can receive without actually increasing your risk. So what that means is if you own 3 different types of assets, let's say it's oil, stocks, and government bonds, at 10% risk, you could make more potential gains than you could at 10% risk at just owning stocks and bonds. So what I'm possibly suggesting here is, okay, so if we don't know what the stock market is going to do, if you're worried, get into a large array of assets, because what's going to happen is if you have a couple assets, something like that has like gold, right? So like gold has that negative beta value. Right? So when the market goes down, gold generally tends to go up. If you have that negative beta value with gold in your entire portfolio, what it's going to help you do is, okay, if the rest of the market's going down, if this crash does happen, you're going to have a way to actually sustain and mitigate your losses because gold will, generally speaking, go up. So there are ways that you can build a portfolio that is protected against some sort of crash happening. Long and short of everything I'm saying right now, if you don't want to look at the capital asset pricing model, if you don't want to look into all that type of stuff, that's a little too much. I understand that. I'm not even claiming to 100% understand it completely myself. There's a lot more research I have to do on it. Diversify as much as possible so that you can mitigate your possible losses if one of your stocks, if one of your investments tends to do poorly. Diversify and hold it for a long time. That's the best way we can do it. The stock market historically has consistently grown over time, offering, I think it was over the last 200 years, like 6.6% growth over the last 200 years. And when we compare that to the government bond growth, the stock market consistently grew 3.9% over the last 200 years. Again, I know that we talked about not being able to use history to judge the future, but you have to do something. You do have to start somewhere. And the buying and hold approach does work. It has worked before. Doesn't mean that it couldn't all of a sudden fall out, but I would say it's highly unlikely, especially if you continue to diversify. Just my thoughts on the matter. Let me know what you think. Let me know, do you think this stock market is going to crash again? What are you going to do? How are you holding your money right now? Are you investing? Are you holding cash? Are you buying Bitcoin? Are you buying gold? What do you think of the capital asset pricing model? If you know about it, let me know down below. Let us know. Also, check the description for all of the links to any of the sources we use today, as well as getting your free stock market ebook in the description below, along with a free stock from Robinhood. Maybe you can get a leg up when this market starts to rally. Go get your free stock over at Robinhood. There's going to be a link in the description. It's going to let you claim all of that ready to go. The ebook you can get by signing up for our email list over at the website. Hope you enjoyed, guys, today. We'll catch you at growingau.com, and I'll see you here next time.